Silver tags $109, and then it gets slammed so hard it looks like someone pulled the floor out from under the chart. If you're staring at that candle thinking, was that manipulation? Was that panic? Was that the end of the move? Breathe. Because what happened wasn't magic. It was mechanics. Today we're breaking down the silver flash crash, why $109 got rejected, why it happened fast, and what the price drop did not change, especially if you care about real metal, not just a screen quote. Quick note, this is educational, not financial advice. I'm explaining how markets behave so you can think clearer when the screen turns red. 1. The setup, how $109 became a trap. After silver cleared the historic $100 mark on January 23rd, the crowd did what crowds do. They chased. That chase has a name, retail FOMO. And it's not dumb money, it's normal human behavior. People see a new decade high, they feel late, and they buy because momentum feels like certainty. The problem is momentum also paints a target. $109 was not just a number, it was a psychological ceiling, a round number magnet where orders stack up like cars at a toll booth. And in modern markets, that toll booth is run by algorithms. Above big levels, the book fills with breakout buys, stop losses from earlier shorts, take profit, sells from early longs, and most importantly, resting institutional sell programs. So when price surges into $109, it isn't entering open sky. It's entering a zone where large players already planned their exits. That's how you get a bull trap. Price races up, late buyers jump in, the level fails, stops trigger, the drop accelerates, and you could see the heat in the indicators. On the 1-hour chart, momentum went extreme. RSI pushed into the high 80s territory traders often treat as dangerously overbought. Now, RSI doesn't predict the future, but it tells you the rubber band is stretched. When a rubber band is that tight, you don't need a massive reason for it to snap. You just need a spark. 2. The spark. Risk premium gets vacuumed out. Here's where people misunderstand news. It's not that one headline controls the world, it's that certain headlines change positioning in seconds. In this move, silver had an extra ingredient baked into the price, a risk premium. A risk premium is the extra price people pay because the future feels more uncertain than usual. When traders fear trade friction, supply disruptions, shipping delays, or sudden restrictions, they buy protection. Silver can become part of that protection basket. Then a rumor hits the tape suggesting de-escalation, less friction, less threat, less urgency. And what happens? That entire premium gets vacuumed out, not slowly, instantly, because the market isn't waiting to verify anything. It's reacting to positioning. The safe haven crowd that bought just in case sells just in case as soon as the story shifts. So the first leg down often looks like betrayal. Price drops even though nothing happened in the real world. But something did happen in the real market. The reason for that extra premium got repriced. 3. The accelerant, the margin squeeze that turns a drop into a flash crash. Now we get to the brutal part, because this is where the move becomes violent. Futures markets run on margin. You don't pay for the full contract. You post collateral. When the exchange raises maintenance margin, it changes the game mid-hand. Think of it like this. You're driving on a bridge. Then the toll suddenly triples. If you don't have the cash, you're forced to turn around immediately. A margin increase does two things at once. It reduces leverage across the board. It forces the weakest hands to sell right now. That second effect is why it looks like a massacre. Traders who were perfectly fine at the old margin suddenly get margin calls. They have two choices: wire more collateral or liquidate positions. During a fast drop, wiring collateral isn't instant, so liquidation becomes the default. And liquidation is not rational selling, it's mechanical selling. That's how you get the flash and flash crash, price drops, stops, trigger margin calls, hit forced selling dumps more contracts, liquidity thins out, the candle gets ugly. If the liquidation wave is big enough, it can create a cascade worth hundreds of millions in notional value in a very short window, and that cascade doesn't need a villain, it needs leverage. 4. The key distinction, paper price fell, physical tightness didn't. This is the part most people miss. A screen quote is not the whole market, it's one layer of the market. When paper price drops fast, people assume the real world price is dropping too. But during structural shortages, the opposite can happen. Paper drops, premiums stay high, and availability gets worse, because the physical market doesn't care about your 3-hour candle. It cares about inventory, delivery schedules, and replacement risk. If refiners, mints, and wholesalers have tight supply chains, they don't reprice instantly downward. They protect stock. Dealers protect stock because their next replenishment may cost more, take longer, or require allocation. So what you end up with is divergence. COMEX quote prints $104 while retail premiums remain elevated and certain products stay scarce or backordered. That divergence is not a conspiracy. It's a sign of stress between paper flow and physical flow. And it's why the mantra exists. If you don't hold it, you don't own it. I'm not saying you must buy anything. I'm saying understand the difference between trading paper exposure and securing deliverable metal. 5. The anatomy of the 3-hour crash, the simple timeline. Let's put the move into a clean sequence. Step A. The push price climbs after breaking $100. Momentum gets extreme. The market is crowded on the long side. Step B. The ceiling price kisses the $109 area. Sell programs activate. The move stalls. Step C. The rejection price rolls over. Late longs realize they're trapped. Stops begin to fire. Step D. The headline shift. Risk premium unwinds. Short-term hedges get dumped. Sellers get aggressive. Step E. The margin shock margin requirements rise. Leverage gets squeezed. Forced selling hits thin liquidity. Step F. The flush price wicks down toward 104. Everyone who bought the top is now underwater. Sentiment flips from greed to fear. Step G. The stabilization. Bids show up where they've shown up before. The chart finds a temporary floor. Volatility cools. That's why it happened in hours, not days. It was a chain reaction. 6. What the levels mean now. Your map, not your prophecy. Charts don't tell you what will happen. They tell you where people are likely to react. Here are the 3 levels the market just highlighted in neon. $109.20, the intraday peak. This is the rejection point. It's now a reference ceiling. If price returns there, expect heavy reaction again. $104.15, the flash bottom. This is where panic selling finally met enough bids to slow the fall. It's not safe. It's just where the pressure temporarily balanced. $100, the psychological floor. This is the line in the sand in the minds of participants. If price holds above it, the breakout narrative stays alive. If price loses it hard, the market may search for the next demand pocket. On-screen table suggestion. Level what it means, what happened. 109.20, intraday peak. 2026, high hard rejection. 104.15, 3-hour flash bottom support. Found $100, critical psychological floor line in the sand. 7. So, was it a bull trap or a reset? Here's the honest answer. It was both. For the short-term chasers, it was a bull trap. They bought the breakout late and got punished. For the broader trend, it can be a reset, a leverage cleanup, a sentiment purge, a reminder that markets don't move in straight lines. Big uptrends often include violent pullbacks because leverage builds up like dry brush in a forest. A spark hits, and the fire clears it out. The question isn't, did it crash? The question is, what kind of crash was it? A structural crash breaks the story. A mechanical crash clears the excess. This one has the fingerprints of mechanics, overbought conditions, level-based selling, risk premium unwind, and margin-driven liquidation. 8. What you do next. A calm checklist for the next 72 hours. No panic, no hero trades, just observation. Here's a simple framework. Watch the $100 level behavior. Does the market defend it with speed? Or does it slice through like it isn't there? Watch volatility after the flush. Does the tape calm down? Or do you keep seeing violent spikes both ways? Watch physical signals. Are premiums easing? Are back orders clearing? Are dealers suddenly flush with stock? If those don't change, the physical tightness story remains. Watch the rebound quality. Does price snap back with strength, or does it grind weakly and fail under resistance? Watch positioning language. Are people saying it's over after a 3-hour move? That's usually emotion talking. 9. The takeaway in one sentence. The $109 rejection wasn't the end of silver. It was the market reminding everyone that leverage is not the trend. Leverage is the fuel, and fuel burns fast. If you trade, respect the mechanics. If you stack physical, respect the supply. Either way, don't confuse a flash crash with a final verdict. Closing. If you want, comment one word so I know which side you're on. Paper, if you watch the chart. Delivery, if you watch availability. And if you stayed to the end, you already know the real lesson. The loudest move is not always the most important move. The quiet signal is whether metal can actually be found at any price. 1A, a quick picture of the battlefield, what you didn't see on the candle. When you look at a chart, you see the result. You don't see the fight. At 109, the market was basically a crowded hallway. Everyone was pushing in the same direction. Breakout traders buying the new high, short sellers covering to avoid getting run over, options hedgers chasing delta and momentum systems that only know one word, go. But on the other side of that hallway were bigger, quieter orders. Institutions often sell in slices, not in one dramatic dump. They'll place layered offers above a key level and let the crowd do the work. The crowd provides the liquidity, the crowd provides the urgency, the crowd provides the exit. So when price hit $109, the market didn't discover a top. It collided with one. This is why round numbers act like magnets and walls at the same time. Magnets because everybody stares at them, walls because everybody places orders around them. The higher the attention, the thicker the wall. Why RSI at 88 matters. Without turning RSI into a fortune teller, RSI is just a speedometer. At normal speeds, the market can steer. At extreme speeds, the smallest bump can cause a spin. An RSI in the high 80s on a 1-hour chart tells you the move is not steady, it's sprinting. And sprints end the same way. Either a cool down, sideways chop, or a stumble, sharp pullback. So when you saw that 3-hour reversal, it wasn't impossible. It was statistically common in stretched conditions. And here's the cruel part. The more excited the crowd gets, the more leverage they add. The more leverage they add, the more fragile the move becomes. That fragility is what $109 exposed. The headline effect, explained like a mechanic, not like a fortune teller. Markets are not reading newspapers. They're reading positioning. A rumor doesn't have to be true to move price. It only has to threaten the reason people were positioned a certain way. When a de-escalation rumor hit the wires, suggesting less near-term trade friction, the protection trade unwound. That protection trade had been long safety, and silver was part of that basket for many participants. So the sell button was not pressed because someone changed their worldview. It was pressed because the risk math changed in the next 5 minutes. If you want to understand the speed, remember this. Algorithms don't debate. They execute. They see a keyword cluster that historically reduces risk premium, and they rotate out. The human explanation comes later. The price move comes first. Margin mechanics, with real-world intuition, let's make margin concrete. A standard futures contract represents a big amount of metal. You control that exposure with a much smaller deposit. That's leverage. Leverage is powerful when price moves your way. Leverage is brutal when it moves against you. Now add a margin increase during volatility. If your maintenance margin jumps by a few $1,000s per contract, a trader holding multiple contracts can suddenly owe tens of thousands in extra collateral. And here's the trap. The margin call arrives when the market is already moving against you. So the trader can't calmly wait for a bounce. They have to meet the call or reduce exposure immediately. That forces selling into a falling market. This is how a normal pullback becomes a waterfall. Selling causes lower prices cause more margin pressure causes more selling. At some point, the selling exhausts itself. Not because everyone suddenly feels brave, because the forced sellers are finally done. That's the difference between a discretionary sell, I choose to sell, and a forced sell, I must sell. Flash crashes are built from forced sells. Paper versus physical without slogans. The two clocks. Paper markets reprice on the fastest clock. Physical markets reprice on the supply chain clock. Paper can move in seconds because it's mostly contracts, spreads, and hedges. Physical moves slower because it's inventory, fabrication, shipping, insurance, and restocking. So when paper drops hard, physical sellers ask a simple question. Can I replace this metal quickly at the new lower price? If the answer is no, they don't cut prices much. They tighten spreads, they raise premiums, they limit quantities, they protect the shelf. That is why, during tight conditions, the buyer experiences something surreal. The chart shows cheaper, but the checkout shows not available. And scarcity doesn't announce itself with fireworks. It announces itself with little signs. Out of stock, pre-order, delayed shipping, minimum order, allocation, call for price. Those are the whispers that matter more than the scream of a 3-hour candle. The stop-run effect, why the middle of the move is the ugliest. Between the top and the bottom, there is usually a zone that feels like chaos. That chaos is often stops getting harvested. Imagine a ladder. At the top rung, late buyers enter. Under them, their stop-loss orders sit like a trapdoor. Under that, earlier buyers have stops too. Under that, short-term trend systems flip from buy to sell. As price falls, each layer triggers the next. That's why the middle of a flash crash looks like a cliff. It's not one seller. It's a chain reaction of pre-placed orders. And if liquidity is thin, meaning fewer bids are waiting, price has to fall farther to find the next real pool of demand. This is also why you sometimes see a sharp wick. Price drops too far, too fast, hits real demand, and snaps up. The wick is the market admitting it overshot. What professionals watch during a move like this? While social media is arguing about conspiracies, professionals are watching a few boring things. Does the sell-off break structure or just reset it? Does volume spike at the low, capitulation, or remain high into the close, ongoing pressure? Do spreads widen dramatically, liquidity stress, or stay orderly, controlled unwind? Does the bounce reclaim key levels quickly, or fail and roll over again? In other words, they're watching the quality of the damage. Because damage has texture. A healthy reset looks violent, then stabilizes. A structural break looks violent, then keeps bleeding. The emotional trap, why flash crashes feel personal. A 3-hour move can make people feel humiliated. That's because the market weaponizes timing. It makes you buy right before the fall, then makes you sell right before the bounce. Not because it hates you, because crowds behave predictably under stress. When price is rising fast, the crowd feels safe. When price is falling fast, the crowd feels trapped. The market feeds on that flip. So if you felt your stomach drop today, that's not weakness, that's biology. The goal is to build a process that stops biology from driving the steering wheel. 3 rules to avoid getting caught in the next bull trap. Rule 1. Don't chase a level that everybody can see. If you want to participate, plan entries before the level, not at the headline number. Rule 2. Respect leverage during euphoria. If momentum is extreme, assume volatility is coming. Position size should be built for the move you fear, not the move you hope for. Rule 3. Separate your trade brain from your ownership brain. If you're trading paper exposure, accept the speed and the whipsaws. If you're securing physical, focus on availability and replacement cost. Mixing those brains is how people lose clarity. The calm recap. What changed and what didn't. What changed? Short-term momentum got reset. Late leverage got flushed. The market reminded everyone that 109 is a serious wall. What didn't? The bigger story of tight physical signals doesn't vanish in 3 hours. Key psychological levels still matter. The market can still trend upward after a violent purge because purges are how trends survive. One last thought. A flash crash is like a thunderclap. It grabs your attention. It makes you think the sky is falling. But the real weather pattern, the thing that matters, shows up in the slow pressure systems. Inventory, delivery timelines, premiums, and the language of allocation. If you learn to watch those, the next time the candle turns red, you won't freeze. You'll understand the machine. 3 quick scenarios from here so you're not guessing in the dark. Scenario 1, the V snap. Price defends the $104 or $105 zone, rebounds fast, and reclaims the mid-range with strong candles. That usually signals the flush did its job. Weak hands out, stronger bids in. Scenario 2, the staircase grind price chops sideways, forming a messy base. It feels boring, but boredom is often how markets rebuild energy after a sprint. Scenario 3, the second hit. Price bounces, then fails under resistance and revisits the lows. That doesn't automatically mean collapse. It can be the market testing whether demand is real or just panic buying. In all 3 scenarios, your job is the same. Watch behavior at the levels, not your emotions about the headlines. And remember, the 3-hour timeline is not proof of weakness. It's proof of how crowded the short-term trade became. Final anchor line for your audience. When the screen goes crazy, repeat this. A candle can fall in 3 hours. A shortage doesn't disappear in 3 hours. Stay sharp, stay calm. And if you want more breakdowns like this, subscribe, because the next move won't send a calendar invite. If you're tempted to revenge trade after a flash move, pause for 10 minutes, write down your entry, stop an invalidation level on paper, and only then decide. Most losses in days like this come from speed, not from being wrong. Comment trap if you felt it, or reset if you understood it. Either way, you're learning the game. Stay calm, stay ready.